Hey guys, welcome to Market Minds, and in today's video we're talking about selling an option, or you can also call it as writing an option. Okay guys, so without a further ado, let's get started. And if you guys want to watch this video in Hindi, log on to www.marketminds, or I'll mention the link below. Just click on that link. So let's understand what is option writing and what are the intrinsic value and how to find an intrinsic value of an option. Okay, so guys, option writing or selling and buying is somewhat similar. You can say that they are two sides of the same coin. Now when I say two sides of the same coin, that means every stock has two options, right? Whether it is buy or sell, correct? So first thing, you should understand what is a buying and what is a selling. So those of you who don't know what is short selling, that means you'll not be able to understand what is option selling. So I prefer that first you see and what is short selling. Once you understand what is short selling, then you will be able to understand this concept. Okay, so for those of you who understands already what is short selling, option selling or writing is also somewhat similar to what it happens in the stock or derivatives. Okay, so it is the same thing. As you know, there are always 2 points of two sides of a coin, right? One is head, one is tail. The same way in a stock, there is 2 sides. One is buy, one is sell. So that is what I'm trying to explain here. Now, the second most important point, whatever happens to the option buyer, the exact opposite happens to the option seller and vice versa. Now, this is a very interesting topic, guys. So whatever happens to the option buyer, that means an option buyer is bullish. So whenever the stock goes up, the seller is definitely losing some money, correct? And the vice versa, right? Whenever the stock is going down, whenever the stock is going up, it is a loss for an option buyer, seller, correct? For example, if an option writer is making 50 rupees, the option seller buyer is losing 50 rupees. It is as straight, right? So you all know that what goes around comes around. So this is the same example. What I'm going to give here is stock market is nothing but buyers. If buyers are losing money, sellers are making the money. If sellers are losing the money, buyers are making the money. So the money is revolving between buyers and sellers. So this is what stock market is in a very simple term. In a nutshell, what is stock market? Buyers' money goes to the sellers, sellers' money goes to the buyers, and it keeps on rotating unless and until there's a smarter person who earns out of it. Okay, so let's move to the next slide, guys. So let's understand the key points of an option. So if the buyer has a limited risk, now we all know in the previous video I've told that an option buyer will always have a limited risk because his loss is fixed. What is the loss? Loss is nothing but the premium he paid, right? So the option writer has a limited profit to the extent of premium received. Now what is here it is happening? That means the option seller is selling a premium, right? So he's received a premium from the buyer, that is 6 rupees, 7 rupees, whatever. So his profit is fixed. His profit is fixed that he cannot earn more than 6 rupees, because from 6 rupees it goes to 0. That is it. The option cannot go to a negative number, right? So the options are non-negative numbers. So it is obvious that it will go nothing as low as 0. So there is nothing more than 6 rupees he can earn. So the option writer has always a limited profit. The next point, the option buyer has a potential for unlimited profit, whereas the seller has potential of unlimited risk. Now try to understand, guys. It is a very simple thing. Now you know that option buyer, that means he's buying a small premium of 6 rupees. So that means his loss is limited to 6 rupees and the profit is n number. That 6 rupees option can go to 600, can even go to 6,000 also. 6,000 is a very big number actually. So let's assume any sort of number, XYZ number. So that means he has a potential for unlimited profit, right? As I told you in the previous video also, option buyers always have unlimited profits, whereas the option seller has the potential for unlimited risk. Now try to understand, once the option goes above the strike price or the break-even point, that means that particular option can go from 6 rupees to 600 rupees. That's 600 rupees. That 594 rupees is the loss bared by the option seller. right? Because he has short sold the position from 6 rupees, expecting it to become 0 or any number below 6 rupees is his profit. Now if it is going above, you cannot stop where it can go. It can go to n number depending on how the stock moves and from what strike price it has moved, right? The break-even point where the option buyer starts making money and the option seller starts losing money. Now I explained you in the previous video again that what is a break-even point, right? That particular break-even point is where the option buyer starts making money, right? That is from where the option premium is rising above and it is going above the premium paid. That means the option seller will also lose money. Simple. If option buyer view on the market is bullish, the option seller's view is bearish. It is simple. That means I am optimistic, he is a pessimist. In a very simple layman term, what is happening here? If I am bullish on the stock, the option writer should be bearish on the stock. That is why I'm short selling, right? Now, a very important and a very simple topic here. Call option seller's process. Okay, this is a very simple thing. The option buyer has a disadvantage. In 3 scenarios, only way the option buyer can make money is through impact 1, and the other 2 impacts there are advantage for option sellers. The option seller always have an advantage. Why? Because theta is nothing but time decay. We'll talk about this when I'm covering the Greeks. For now, just understand that option sellers always have more advantage compared to option buyers. So in the impact one, the price move above the strike price. It is good for option buyers. It is as good as for an option buyer because the stock will rise above, right? It is a simple thing. The option buyer will buy the stock and it moves above his strike price. That means the premium will also rise. So it is good for option buyer. In the second impact, the price stays flat, moves nowhere. Right, it will move nowhere. Neither it will go up, neither it will come down. So that is where it plays a theta, time decay. So we'll talk about time decay in Greeks. For now, just understand it is good for option seller because it will lose the premium. In the third one, the price goes below the strike price. Good for option seller, correct? It is really good for option seller because it is going below its price. That means the premium is also losing its value. So 2 advantages for option seller, 1 advantage for option buyer. Okay guys, let's move to the next slide. Now if you could see, I'm taking an example of a State Bank of India where I'm believing that I'm bearish on the stock and I'm betting that the stock will touch 360 levels. But instead of buying a 360 put option, what I'm doing is I'm buying a 430 call option. I'm selling a 430 call option. Why am I doing this? Because it is above my strike price and I am choosing that particular strike to receive that particular premium. Okay, I'm shorting my particular 430 call option. Okay, why am I doing this? Is because of 2 reasons. If at all the stock doesn't go here and if it stays flat, still I'm making money, right? And if it is going below, I'm still making money. It is as simple as that. Okay, so let's see what premium I get for that. Now if you observe here, 430 call options, it's 7.90. That means 430 call option I'm receiving a premium of 7.90 rupees. So if at all, whatever will be my profit, 7.90 rupees per lot is my maximum profits. In the above chart, we have taken a SBI March 2021 example as an example where we are bearish on the stock will fall to the level of instead of buying a 360 put options, the seller decides to collect the premium of 430 call options, right? So as I explained, I'm collecting the premium of 430 call option, that is 7.90 rupees. Now let's calculate this, guys. Now let's understand the P&L. Okay, now 380 is what? See, in the last video it was minus because I have paid the premium. Here I'm receiving the premium, that is why my premium is in plus. In the last video it was minus because I have paid that premium. Here I'm receiving that premium, so it will be plus for me, right? So the intrinsic value is simple. So we're subtracting now with the value of spot minus my strike price. So 0 As we all know, it is a non-negative number, 0. That means I'm making 7 rupees as straightforward. Now 430, and again I'm making 7 rupees here. In all the spot prices, I'm making 7 rupees. This is my breakdown point from where I'm losing my money. It is simple. The calculation is simple: premium minus IV, okay, intrinsic value. So first we'll find the intrinsic value, then we'll subtract, then we'll come to know the profit or loss. Okay guys, so I hope you guys are understanding this chart. Now let's understand what exactly happened. The positive sign is that the premium received in the column indicated a cash flow, that is credit. As I said you before that I'm receiving a premium, that is why the cash flow is credited to the option writer. The intrinsic value of an option of an expiry remains same irrespective of a call option buyer or seller. The intrinsic value, as we said, that particular formula what we did. When the option seller writes an option, he receives a premium. Here it is 7.90. He would experience a loss after he loses the entire premium, that is the premium received is 7.90. If he is 5 rupees, he still is in a profit of 2.90. Hence, the option seller has to lose the premium he has received. Any money he loses above the premium received will be his net loss. Hence, the formula is premium minus intrinsic value. So now you understand one thing. First, he has to lose this premium, right? The option seller has to lose this premium because he has received this premium, and then his loss will begin. So the formula now we calculate is PNL is equal to premium minus max 0, spot price minus strike price. Okay, now let's see the breakdown point. Okay, the breakdown point of a option selling. Now you can see here 430, 431, 432, 434 and irrespective. That means it is going above my strike price. In order to understand how I'm losing my premium, see, as I told you, first I'm going to lose my particular premium, then my loss starts from 438 guys. Okay, from 438 I'm losing my money. So that means till 437 I'm still in a profit of 90 paisa. So you understand this. First I'm losing whatever the premium I have received, then I'll start making the real loss. Okay, now let's move to the next slide. Now observation, if we can see that even if the spot price moves above the strike price, the option writer is still making the money. He continuously makes money until the spot price reaches the strike plus premium received. At this point, the seller starts making money. Hence, we call this as breakdown point. So we all know what is a breakdown point. It is similar to break-even point, where we call it as breakdown point. Okay. So breakdown point is equal to strike price plus premium received. Now SBI's breakdown point is 430%. 437.90 is my breakdown point. That means at this point, I'm neither in profit, neither in loss. So if we calculate this, we can see that in the chart, you could see this is a chart. So this is my breakdown point. So from here, either I'm in no loss, no profit. From here, I'm starting losing money. I've started to make losing money, right? Let's move to the next slide, guys. Now, very important thing, guys, to understand what is a European option and an American option. Difference between European options and an American options. So first we'll understand the history. When the options were introduced in India, there were two types of options, European and American. All index options, index as in Nifty and Bank Nifty guys, were European, and the stock options were American. Now what are European options? If the option type is European, then it means that the option buyer will have to mandatory wait till expiry date to exercise his right. The settlement is based on the value of spot market on the expiry day. Now, if you could see this, if the European option is nothing but he has to wait mandatory till the expiry day to settle his option, to exercise his option. So this is European options. Okay. For example, if SBI 430 call option has been bought, then the buyer has to be profitable on the day of expiry. That means the price has to be above his break even. If not, the buyer loses the premium whichever he has paid to the seller. So we all know what exactly it is happening here. So it is mandatory on the expiry day for 430. It has to be above his strike price. That means the spot price has to be above the spot price should be above this particular strike. That means 440 or 450 in order for him to be profit. Else he'll lose the complete premium. Simple. Now let's understand what is American option. In American option, the option buyer can exercise his right to buy the option whenever he deems appropriate during the tenure of the option expiry. The settlement is dependent on the spot market at a given moment, not really dependent on the expiry. Now, here in American option, what is the common thing is that he can buy it at any time and he can sell it at any time. For example, if SBI call option has been taken and trading at 420 at a spot market, there are 10 more days for expiry. The next day SBI crosses 430. In case the buyer can exercise his right, and seller is obligated to settle with the option buyer. So it is simple. He can buy it at any time. He can sell it at any time. In layman terms, we can say buy options and sell them anytime we want, even after an hour of purchase. It is simple. That means I'm buying the option now and I can exercise it at any point of time, and seller is obligated to exercise the option with me. American options were completely taken out from derivative segment due to higher price issues. So all options now in India are European in nature. Now, American options were completely taken out because of higher price, guys. So every time there was a higher price, the seller used to lose a lot of money. That is the reason why American options were taken out. Now European, every option is now European in nature. So it gets only settled in expiry day. Okay. Thank you for watching this video, guys. Contact us if there is any queries. You can always call us on the number. This is our website and this is our email address. As you know, this is the ritual which we follow. Anyways, guys, thank you for watching this video, and I hope you have understood what is option writing and selling. And if you guys have not, please comment down below and I'll try to explain as much as possible. And also do subscribe this channel, guys. We are doing a lot of efforts for you guys to understand and make finance learning easy. So hope you guys enjoy this video, and also comment what next you want to learn. Okay, so wait for the next part of this video where we'll be explaining about the different parts of options. So we're coming with the videos very soon and frequent, guys. Thank you for watching, guys. Please do consider subscribing.